This is almost too obvious what's going on in the stock market as the event risks keep piling up. You know, the contrarian in me wants to believe that these bearish narratives and all this stuff that's being plastered in front of our face is going to quickly reverse and the market's going to continue higher. That's the contrarian in me that really believes that. However, we can't ignore all of these bearish things that are just piling on top of each other. And in today's video, I'm going to be sharing with you a lot of these bearish things that are piling up because you need to be well aware of it with everything that's going on in the markets. If you're new here, welcome to the channel. My name is Michael Silva. This is the Stock Market Brief Show. Hit subscribe for me. I'm almost at 100,000 subscribers. I've been doing this for a couple of years. I actually left my full-time job to do this. Every time you hit that like button, you're basically sponsoring this show. Every time you hit subscribe, I really greatly appreciate it. Thanks to all the Patreons out there too that support this channel. Let's go ahead and get into today's episode. Alrighty, everybody, we're going to start off looking at the VIX. Oh, what's wrong if Michael's starting off here with volatility? Well, I want to call out that yes, volatility levels are high. We're back above 25, just under 30 on the VIX. I want to be clear here and give you an analogy. I did this on my Twitter. Okay, so if you don't follow me on Twitter, you can follow me there to maybe get some insight into what I might be talking about on these briefs. And then you can come to these briefs to get a little bit more information. Look at the VIX, and not only the VIX, I'm going to just show you actually the RVX, so Russell volatility, right? This is back over 30 quickly, right? And closing right at around 35. That's Russell volatility. That's high. That right there is just saying, hey, be very careful. You're going to get chopped up. VXN, this is Russell. Sorry, not Russell. NASDAQ volatility. That's back above 30, over 32.50, almost right there at 35. Also very high. Now, understand this. This is the analogy that I used on Twitter. I'm going to try to make it quicker here. You know, I used to live out in Santa Cruz, and I'd always go out to the ocean. And here's the reality. When the waves were nice and small, and you're looking at the ocean, you'll see many, many people out there, okay? You'll see little kids. You'll see older people. They're out there boogie boarding. They're out there surfboarding. You know, they're hanging out. Lots of people, okay? Oodles and oodles of people. However, when the waves got bigger, right? The waves got bigger, you would see less and less people out in the water. Why? Well, first and foremost, the parents of these kids wouldn't allow them in to the water because it's very dangerous. You know, I don't know if you ever fallen off a wave. I've fallen off about a 5 or 6 foot wave when I lived out in Santa Cruz. And not only did it hurt, but getting out of it was very, very difficult because once I struggled to get air, I was hit by another wave. All right, I'm getting off track again. Understand this, people dissipated out, but the people that were there were the people that were equipped and prepared and understand how to surf in those type of environments. Okay, now why I'm calling this out is because when we're down here I'm going to go back to the VIX. When we're down here at the VIX, it's nice and sunny out. The kids are out to play. Everyone feels like a superhero. They're catching waves. They're skimboarding. They're boogie boarding. When you're up here, you're facing Mavericks. And if you don't know what Mavericks is where they host professional surf competitions. The waves are gigantic. Okay, and what you will see there is only professionals. Now, that's not to say that you can't surf Mavericks, but just understand that even if you were to catch a wave and you're like, yeah, I did it, doesn't make you a professional, unfortunately. Okay, so the reason why I'm saying that is understand the weather right now. It is very rough. It's very choppy. Now, if you're a captain on a boat and you're an investor, that's a different way to think about it, right? If you're a long-term investor, you're going to go through many different storms and you're going to see this stuff. Okay, but here in this area, I'm speaking to the people that like taking risks when they probably shouldn't be taking risks, right? They see that huge wave and they're like, I can probably do that. That's nothing. Be careful, all right? So what do you do in these type of environments where volatility is this high and the risk ranges become very big? You need to reduce your position sizing, especially if you want to play in these type of waters. And then you typically have to widen those stops. Why? Well, because you're going to get stopped out a lot. All right, so if you want to see, and we're going to go through a couple trade ideas here, right, on the indices, but that's just a couple of tips that you can, use in this type of market environment. Now, things are looking bearish, right? Now, volatility can go up or down, right? So That's not necessarily, I mean, it's a little bearish, but bear with me, okay? There's a couple other things that are very obvious here. First and foremost, let's look at the weekly time frames. Okay, this is the weekly recap. Down 1.82% on the S&P 500, and well, guess what? We're closing below all those key moving averages. And we have an inverted hammer, well, not really an inverted hammer, but a pretty bearish looking candle, and one right there too, okay? So as we're coming into that 50-day moving average, which is the 10-week moving average, we have, some overhead supply there. And it outweighs that demand, which pushes prices down. And you can see the 5-week moving average, it's pretty much straight down, which is not good. Okay, and then you have the RSI below 50, and you have the PMO that's now getting pretty trend-worthy to the downside. You can see the lines separated, and they're both pointing pretty much down south, okay? Not looking good overall right there. And it's pretty obvious, right? NASDAQ 100, similar situation, but you can see a lot more relative weakness here, being where it is in relation to those moving averages, well below the 10-week. 5-week moving average is actually below the 40-week, which is the 200-day moving average. And this weekly candle was down 3% on the week in the NASDAQ 100. And let me tell you, some of these FANG stocks, Microsoft, Google, they're starting to look like topping patterns. You can actually look at some of these, and they're pretty similar to this, where it almost looks like they're forming some sort of a head and shoulders pattern. And I'm not going to put too much weight on these head and shoulder patterns at this particular point in time because we've seen them not work multiple times. And in an event-driven risk environment, sometimes technicals they don't matter nearly as much, but certain key levels and areas of supply do. Okay, so let's keep going. Dow Jones Industrial Average is relatively flat to sideways. It was down 1%, but it is below all those key moving averages with that declining 5-week moving average, and you can see some supply as it hits that 10-week right there, which is the 50-day moving average. Now I want to show you a couple other things. So Russell 2000, this one was up on the week, so you had some relative strength there, but understand where it came from. It was greatly hit to the downside, and now we're seeing sort of a snapback. Looks like a shooting star type candle. So yeah, I think this can go up again and try another run, but just understand if it starts taking out the low, that's also some continued weakness, especially if the week closes below there. You can see it's getting pretty overextended from some of those key weekly moving averages as well. NASDAQ composite, very similar to the NASDAQ 100, right? But this hosts a lot more stocks, give you a better view on the market, also below all those key moving averages. Now this is where it gets a little obvious. We're looking at the Wilshire 5000, down 1.29% on the week. This composite gives you a very good overview, right? Because it's an index composed of everything in the United States, all right? And this right here is also not looking too healthy. It's below those key moving averages. You have declining 10-week, 5-week, and you're below that 40-week moving average too as well. Now, what makes this even more obvious is just how basic and technical this is. It's almost like it's too simple, right? So first and foremost, this is the Wilshire 5000. The reason why I'm showing you this is just to give you a good idea of the United States markets right now. Okay, we had an up channel. It was going good. All of a sudden, though, you notice a couple of things. One, we got this double top. All right, so as some indices actually started putting in a higher move, this one put in a double top on a negative divergence and played to the downside. It then cracked through this channel, which is never a good thing. Okay, got below that 200-day moving average on a very sharp sell-off, and then we've seen a recovery bounce. Guess what? We came up, we retested that 200-day moving average, which is very likely to do, and we got rejected. Now it's forming a bear flag. So not good at all, by any means. Now this doesn't mean that it's going to go whoop, but we got to leave that as a potential possibility if we get this continued weakness. There's plenty of things where you can go like this and it could go up. There's so many different scenarios, but for technically speaking here, like this is just textbook. It's almost too obvious. Now, a couple other things to note. TNX, the 10-year yield, got back above that 2.0, right? That was big news to see that rise like that. Now, I want to just call out, yeah, we called out this before it broke out. Now I'm calling this right now, hopefully before it breaks down. That could actually potentially see the markets. Now, like I said, there's a lot of event risks that can potentially play out here. But that could potentially help tech stocks overcome some of these oversold conditions if this comes off. We have a rising wedge on a negative divergence, still in a positive uptrend, so it may come off just slightly here. So I'd be looking at that coming into next week. If you take a look at the TLT, this is where it gets interesting. I don't have the volume on here right now, but the amount of volume that was traded on the last couple of trading session was absolutely incredible. So you have to wonder that if there is more event risks, if we're going to see a flood to safety in bonds. Now, I've been talking about that since up here. I took a broke-even trade. Now I want to call out it is still in this falling wedge pattern, and we're below this little volume shelf profile right here, okay? This volume shelf profile right there. And then also it's an area of resistance, 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 and we broke back tested support, bam. And then you can see we're coming down below. So if we start getting back above, I do think that this actually sets us up to potentially come to around that 143, 144, at least at minimum 141, especially if that 10-year backs off. Now, we have a falling wedge, and we also have a positive divergence forming right here too as well. You can see it's basically a flat matching lows right here, and you have a low to a lower low here, showing that the momentum to the downside could very well be slowing. Now, another thing to call out here is see this, how this kind of volume kind of like pocket right here is at. That means that if we start getting above it, it leaves the room to hit that next magnet potentially right here, which is, like I said, that 142, 143. So if you're looking for a potential flight to safety, or you do want to, expose yourself to bonds, this could be a potential play. You can look at the TLT, or you can look at, I think it's the TMF, which is a leveraged play. And if you don't understand how leverage works, I would highly recommend you do your research on understanding those leverage trades before just hopping into that. Now, if we take a look at the dollar's just back in its trading range, and you can understand here when it comes up a little bit, we're starting to see that weakness back in the S&P 500. And what's interesting here is even the move up in the dollar, we did see a move up in gold and also oil. So even though the dollar moved higher, there was that flight to safety. Now, is that going to hold? I don't know. There was news, right? This triggered up very, very quickly and very fast when the news dropped about Russian potentially going into Ukraine. And what we're seeing here is gold tagging that upper resistance zone, and it's still within this symmetrical pattern. So we're going to be watching this very closely to see if we can potentially get a breakout. And now, I've stated this before, and I'll state it again, oil keeps continuing to move stronger and stronger on a negative divergence. It looked like it was weak, but as soon as that news came out about the Russian-Ukraine, oil started taking off like crazy, very, very quickly. And, if that, something does actually take place here, this could have a lot more room to obviously run. Now, be very careful in this environment because rising oil prices, especially at a rapid rate of change, if you go back through history, all these like really fast, rapid rate of changes led to forcing the Fed to do something or take action as far as raising rates go. And also the markets, you did see very frequently sell off. Now, if you want a little bit more detail on that, on my last video, I talked about, the various times where we saw rapidly rising oil, how that caused specific recessions to take place. Now, let's continue on to the next slide. The next slide is more just showing over some safety, relative strength stuff. So we have gold right here, utilities, XLP, TLT, defensive, and then healthcare. Now, I just want to call out, right? We talked about it when it was coming back down. I said it's not down and out yet, so be very mindful of that as they're still above those key moving averages. And you can see they're all turning up from a relative standpoint here, once again, given Friday's trading session and Thursdays as well. All right, now if we look at the relative rotation graph, there's clear winners, clear losers here, right? This is looking at a 4-week tail length, and you can see here energy is, in the last 4 weeks is the only sector that's up right now. And you can see here defensive names still continue to creep in that leading quadrant, and you can see the big dogs right here, XLK and XLY. XLY is moving into lagging. XLK looks like it could be there potentially soon. Now, if the 10-year yield backs off, and it backs off fast, XLK may catch a bid and might start turning up a little bit, but it's nothing to get overly too excited at this particular point in time. We need more data. Now, if we take a look at all the composites year to date, the indices, NASDAQ, NYSE, Dow Jones, S&P 500, the Qs. We have gold and then also the US dollar. What do you notice here? These are the only two things that are positive year to date, and that is gold and the dollar. So we have very defensive posturing as we're seeing some of these names down 12% year to date. And those two right there is the NASDAQ and then the Qs. Okay, so it's a very seeming like a very risk-off environment and more defensive posturing here, like I've been trying to state. Now, if we take a look at the 11 sectors that make up the S&P 500, you can see the only two positive right here is energy, and then you have financials down here, but it's, coming off a little bit right now. Now, financials typically do good when you have the 10-year yield, the 20-year yield rise, because banks borrow short-term, they lend long-term. However, I want to just caution you that even if that continues to happen, we're starting to see the yield curve continue to flatten out to potentially invert, and financials do not do good in that type of environment. So be very mindful of that. Now, when I talk about event risks, what am I talking about? Well, we have all that CPI data that came out higher than expected, 7.5%. So the Fed's going to be putting things into action. I don't know what it's going to be. I don't know when they're going to do it. I don't know how the market's exactly going to respond. A lot of people believe that they might, but we don't know what order flow is going to look like until it starts to happen. And then we also have the Russian-Ukraine potential, invasion going on, which is going to dramatically impact market order flow. As we saw, as soon as the release hit, we saw gold spike incredibly, and also oil. All right, so those are going to be some things to watch for. Hopefully, this is mitigated and things calm down here. And then we have, Fed Bullard talking about an aggressive rate hike path. As soon as that news dropped, we saw increase in just wild market order flow also take place. Now, what do we have next week? A couple things to pay attention to. I believe Monday it is. You have Bullard coming back out on CNBC. Could that potentially shake up the markets like it did on his previous announcement? Perhaps. It's just something to be mindful of coming into next week. And then we also have PPI coming out too as well. I believe that's Tuesday though. Now, I'm going to go over a couple of indicators before we get into our risk ranges. Okay. First and foremost, this is one that I post on Twitter. This is the advanced decline line. Okay, it allows me to know really, okay, so if I compare this to the New York Stock Exchange, right, NYA right here, we'll use that as the proxy, are they moving hand in hand? So if this makes a new high, is the New York Stock Exchange making a new high with it? And if it's not, it could potentially be an opportunity. Now, this is where it gets a little crazy. The advanced decline line already broke down from this area of support. Now you can see here the area of support on the New York Stock Exchange has actually not even broken down it. So we're seeing here New York Stock Exchange move up and come off a little bit, but we're seeing the internal saying, hey, we're weaker than what is being led on the price action of the New York Stock Exchange, a divergence. And you can see that here too, right? So it came back to back test. You have a high, lower high, but you had a high to a higher high. That right there was a negative divergence, and we started selling off as soon as it was basically noticed. So the fact that this is below this area of support, if this is not recouped, this could be an early indication that we will be heading down at some point, breaking through this area of support. Not the greatest look, right? And if you look at the advanced decline volume line, this has been diverging for quite some time. This has been heading lower and lower and lower, lower highs, lower lows. And this price action, well, it's been relatively flat, but also putting in higher highs, kind of creating a broadening wedge pattern. Now, a couple other things to note that might not be as bearish, but also not that bullish, right? So from a bullish perspective, this is getting a little overextended. This is the NYSE. Okay, the summation index. And it's starting to curl itself over a little bit here, which could be positive for the short term, but it's still well below zero, which is not that great. But also, as I've been calling out in previous episodes, when this NIMOT reaches a minus 300 reading, when this is below zero, it happens far and few between, but there has been some very, very wild price action, and it could lead to more significant sell-offs. You could see that here it happened. The price action of the S&P 500 actually moved up, but then came back down and reversed it. Here, that was 2018, very similar. Boom. And then this right here was the pandemic too, giving us some insight into potential further downside. And this happened again here. And as you can see, we're just chopping around right now, potentially going to test the previous low, January 24th. Now, the Pring bottom fisher, I haven't brought on for a while, but as we're heading lower here, this is actually curled back up. So that's actually a more bullish sign to see this start to curl up. Now, I don't put too much weight given the context of this current market right here. I still, like, volatility is still very high, but however, seeing this start to curl up could be an early indication that, volatility may subside here and we could see potentially a bottom being formed. It could be a short-term bottom. It's too hard to tell, but from a bullish perspective, that's at least good to see. Now, the CPC, this is a put to call ratio. I apply a 10-day moving average to it. Now, when this black line, that's the 10-period moving average, crosses from above to below the green line, that I consider a buy signal. And it looked as if we were heading down that way, and we very well may. Okay, so I'm going to be watching for that to cross down for a potential buy signal. Now, I want to call out this. The CPC daily time frame is that purple line in the back, and we saw a spike going into Friday's close. So that could very well start to bring back up this line, and the more that it climbs above 1.0, the more risk that we see in this system. And as you can see here, when we climbed above 1.0 and started moving higher, we did see a very quick, bounce up, but we did see some continued selling. So it doesn't mean that a crash is going to take place, but we could see some further pressure, further volatility in the near term. Now let's look at the risk ranges. The risk ranges. So this was last week, right? We talked about a lot of volatility. Okay, we had a range from up here to down here, and as you can see, we moved up and we came back down and closed pretty much at the lower end, just below that 200-day moving average. What is next week pricing in? A bigger risk range. It's moving, putting in a potential plus or minus $13.59 move. That is a big, big move for either direction. So continued volatility remains here. And you can see it can be a very snapback to the upside. And if it is, make sure you're looking to take profits if you catch a move up there. Because if it's a very quick snap, chances are we can still see what we saw here. It's a quick snap and a snap back down. Now, if we all of a sudden get a very fast hit to the downside, I would start to look for actually a long position to play a bounce. Because, come on, 427.50 coming down there very quickly. And we have previous support, and that was the previous bottom here. That I can imagine that we could see some sort of bounce from there. It's gonna, the price, it depends on the price action, what it looks like when it actually gets down there. But just understand this, that is a wide range of volatility and allows for a lot of things to happen. Here's the VIX on the 30-minute time frame. Last time we showed this was before it actually broke out. I was talking about how, a lot of people don't like using technical analysis on the VIX, and people are typically made fun of for doing it. However, it has been pretty good for finding support and resistance and looking for various wedge patterns. And, well, it broke out and it screamed higher. It got pretty overextended. It started coming off a little bit, but it's still relatively high. We have two gaps beneath us, but keep in mind we have one gap above us still at 45. What can volatility really do? I think volatility could subside, but what we need to watch for is this. If volatility wants to start exploding, if price action gets below 420, I think that's going to be the cause. I think volatility is going to go through the roof. I think you're going to see just some crazy things take place if we start taking out that lower level right there. So be on the lookout for that. Now, if we take a look at the 15-minute time frame, overextended to the downside, right? We had just a very weak Friday trading session. I was looking for a bounce, but it was just like this. Support levels were kept on getting hit. Resistance kept on holding and holding and holding. Typically, in a good environment, what you want to see is support, hold, and resistant, break. But that was just not the case, okay? And this could be all because of all that news and event risk that's currently out there. But from a technical perspective, we're below that 5-day moving average. It's starting to curl over a little bit, getting a little extended. So if we start to see a bounce up, start looking at that 5-day moving average or potentially just below 455, which is the upper risk range as that area of resistance, especially if we continue down. So these overextended levels, they can get worked off, but that doesn't mean we're out of the woods, because that could just put a high to a lower high right there, okay? So be very cautious of that. If we take a look at the BP SPX chart, it is telling us not much at this particular point in time. It's good that it's back above 50, but understand this, it's not near, it's overextended to the upside section, so it could definitely turn around, but it's not oversold either, so it still has room to potentially go down. Just wanted to update you on that chart. If we take a quick look at the Qs, whoa, holy crud, 14.454 expected move. That was bigger than the last week, so volatility is still here. What's its pricing? It's potentially saying, hey, we can come down to retest the January low right there, which would cause all kinds of panic in the market. But just be mindful that, and then by the way, also the gray shaded lines, the light gray ones, that was last week, and you can see where we closed, right at that lower end. We tried to come up, but we came right back down to the lower range. All right, so don't be shocked if we do something very similar. Don't be shocked if we go like that, right? It all can happen here. And the Theo team, they said 70% of the time, it's just slightly under that. Price will close within this range come the next week, right? This is the weekly risk range. All right, so we'll see here if it closes within that range. Just understand, if it comes and snaps down right out of the gates, first and foremost, be very careful, because it doesn't mean that that's going to be support. it can go further down, which would cause dynamic hedging to take place and cause further sell-side activity and cause volatility indexes to completely explode. Okay, so be careful there, but just understand this too as well, that it can potentially act as support in specific areas due to previous price action, such as this candle. So if you're looking at intraday possibilities, what I'm trying to tell you is if price gets down there fast and you want to take a long shot at it, make sure that you're, in a volatile environment, reducing position size and taking a stab at it, but having stops or preventative risk measures in place to protect yourself. Okay, now if we take a look at the cues on the 15-minute time frame, I was actually tracking this wedge pretty much all day looking for a breakout, very similar to the SPY. Did not get it. It just kept on getting more overextended. And you can see here RSI is burnt to a crisp. Doesn't mean it can't go further, right? Breakdowns do occur and have occurred in oversold conditions. Doesn't mean they always have to do that, but they have. Okay, but we still have that wedge. So a hit to the downside very early on in the week will bring this to even more overextended, potentially causing some sort of forceful rally. And that's why I'm saying, hey, that's a possibility there. We do have a volume shelf right here, so 342.50 to 345 can potentially also, if we come down here, act as an intraday bounce. Now keep in mind, if we come up out of the gates, it breaks out of the wedge. Hey, we're all doing great. Understand the 5-day moving average, flat to neutral, but we're well below it, so that'll start turning down, and we're below that risk range, so that could be an area to either, if you go from the long side, take profits and or start to look for possible short positioning. If you understand how to short, I mean, it's dangerous, and like I said, this market is very volatile. BPNDX chart, just want to give you a quick update here. Still has room to go down, still have room to go up, right? We tagged it right here, got overextended just so slightly. I don't even think it hit 70. I think it hit 69 point, something. And then it started getting, selling off there a little bit. The RSI started coming off, and that just tells us that we have more room that we could potentially go down. We got to pay attention to these market signals coming into next week, because the market signals can give us some insight more than just the price action can. So keep an eye on these market signals. All right, everybody, that's all I got for you on this episode. To recap, the bearish conclusions keep on piling up. All right, things look very obvious in this market that it could get continued weakness. Now, my initial reaction is to become a contrarian and be like, okay, this actually means when other people are fearful, you want to get greedy. But here's the reality. Volatility is not giving that option to us to be greedy. Volatility is saying, hey, you're at Mavericks, right? You're at a very, very wild ocean, so be careful. I personally wouldn't want to just jump into the ocean or surf a Maverick wave, right? I am by no means a professional, and I want to protect my capital, there's really no point to get in at this particular point in time on specific trades, unless if you're a day trader, right? So I'm talking specifically about swing trading and sometimes investing. Swing traders don't like this environment because if you have price action moving up to a pivot and it breaks out a little bit and volatility is this high, you'll see countless times it come right back in. And that actually becomes a short opportunity. Now, when volatility contracts and it comes down, things change. But in a high volatility environment, this is great for day traders if you know what you're doing. And you could make some good money. You just got to be very careful. All right. That's all I got for you. Hopefully you guys are enjoying your weekend. And I will see you back here next week or later this week. Goodbye.